So my name is Mitul Kotecha. I'm the head of emerging market strategy at TD Securities. I've been at TD for about coming up to 5 years now, but I've been working in different banks for over 25 years in Singapore, Hong Kong, and London in various positions in strategy and research, either FX, global macro, or emerging markets, and even some equities. So generally covered all sorts of asset classes, but currently, as I say, I'm running the emerging market strategy. There's a number of channels to tap into China's capital markets, and China has increasingly tried to open the door to investment channels, whether it's QFI, QDI, in terms of Bond Connect, CIMB, etc. There's a number of channels that foreign investors can invest in Chinese bond and equity markets, and that door has been getting more and more open. Now, it's still some way to go before we see a free movement either way in terms of bond and equity transactions, but clearly the door has widened. It is now much easier for investors to access China's bond and equity markets, and that's resulted in the last several years in quite a significant increase in capital inflows into China's portfolio assets. I think China's economy is obviously undergoing a slowdown at the moment. There are a number of issues that are besetting policymakers and the economy in general, not least of which is COVID. Now, exports are weakening at the moment. There is some ramping up of infrastructure spending, which is helping the growth outlook, but infrastructure on its own is not enough. So when you have exports slowing down, the property sector under a huge degree of pressure as well, and exports likely to continue to remain under pressure, it's unlikely that we're going to see a big ramp up in China's growth trajectory. And so we're forecasting 3.1% GDP growth in China this year, 4.7% next year. Now, in answer to your question, can it escape a Japan-style deflationary spiral? I think it can. China's not in deflation. There is low inflation at the moment, but that's not a bad thing in a world where inflation is high and in double digits, even in many developed market countries. But I think for China, there is a structural change that's taking place with an aging population, lower productivity growth, which suggests that overall trend growth in China is declining. But again, China trend growth could be around 4 to 5% when you compare to Japan, which is probably around 1%. So it's still a long way to go before China gets to that Japan type of deflationary spiral. I think there certainly has been a degree of caution among foreign investors. When you take a look at different channels of investment, for example, direct investment flows last year were extremely strong. This year, such flows have slowed, partly because globally direct investment has slowed down, but also because there is a little bit of concern about China's slowing growth trajectory, and as you said, a number of geopolitical factors, and that's a result. And of course, the fact that the US has leveled sanctions against Chinese companies, especially in the tech sector, has also resulted in some caution among foreign investors who were previously going to invest into China's infrastructure and asset markets. So clearly, as you mentioned, geopolitics has an impact, but it's not just geopolitics. There's a number of factors that have resulted in a weakening of investor sentiment, at least in the last few months, towards China's asset markets. This could reverse, of course, if growth starts picking up. There's already signs of some easing intentions between the US and China, as we saw recently, and I think that could also help the investment climate towards Chinese assets. China has a lower inflation trajectory compared to the Fed in particular, compared to the US. China has benefited generally from inflation this year that's probably going to be just over 2%, whereas this year in the US it could end up closer to 7%. And the reality is that some of the constraints, the pressures on inflation that many countries have seen has not affected China in the same degree, and that's resulted in inflation being relatively well contained. When you take it CPI, as I mentioned, it could be around 2%-ish. When you talk about PPI inflation pressures, they're actually negative at the moment. So we're actually seeing a deflationary pressure on producer prices. And that's meant that the central bank, the PBOC, has been able to keep policy relatively accommodative and potentially could ease slightly more, while many other central banks, as you mentioned, including the Fed, will likely continue to tighten in the months ahead. For example, we're looking at another 50 basis point hike from the Fed in December and further hikes as we go into next year. But we certainly don't see that coming through from China. And I would also add that China is not just, its policy is not just contrasting with the Fed, but it's also contrasting with a number of other emerging market central banks globally that are having to hike interest rates, even in Asia. So China does stand apart from a number of countries in that respect. Well, I think it's going to be a challenging time, and clearly the growth outlook is still clouded. The environment is a tough one. US rates are still going up. The Fed is still going to hike rates. The US and Europe are sliding into recession. That means external demand for Chinese exports is slowing down. And as I mentioned, with exports slowing down, it's going to be very difficult for China's economy to grow rapidly next year, which is why we're expecting a 4.7% handle on Chinese growth next year compared to about 3.1 this year. But again, a lot of that recovery is base effects rather than any big push for growth. The reason that the authorities aren't really pushing growth significantly or pushing more stimulus is because there is a worry about leverage, and they do not want to push up debt levels at a time when debt is already at a very, very high level compared to GDP. So I think for that reason, we would be cautious about the growth outlook. We do see some recovery, but again, it's not going to be a rapid recovery in China's growth. Well, I think it's a great environment for people to get together. It's great that finally after COVID we can all meet face to face rather than WebEx and various other channels where we've all been spending a lot of time on in the last couple of years. So it's great to meet face to face, to share views, to hear different views. So I think it's a very good venue in that respect. I think that's probably one key thing. The second thing is that it's it is again people who haven't seen each other in a long time. I've finally been able to meet, and I'm seeing many people I haven't seen in a long time and catching up with them. So it's great in that respect.